Most traders spend years trying to improve themselves. They journal, meditate, and analyze their emotional patterns. They read books about discipline, consistency, and the psychological side of trading. Yet, despite all this effort, many still lose. Why? Not because the inner work doesn't matter, but because they skip the most crucial question. Does my strategy actually work? It's not about whether it feels right. It's not about whether it worked last Tuesday. It's not about whether it makes sense on paper. It's about whether it has consistently delivered results over hundreds or thousands of trades across different market conditions, backed by real numbers. Do you have that data? Ask yourself this. If I asked you the win rate of your strategy over the past 5 years, could you give me an accurate answer? Or did you only backtest a few months and assume it's profitable? The truth is, most traders don't know their strategy's performance over the long term. They skip this step, thinking they're fine. I made this mistake myself. I remember Ryan, a trader in his third year. He had a disciplined mental routine. He never revenge traded, followed his rules consistently, and maintained controlled drawdowns. His emotions were balanced. On the surface, he was doing everything right, but his account was slowly bleeding. Small, consistent losses month after month never turned into profit. Ryan assumed he needed more discipline, more patience, more mental work. He kept focusing on the psychological side of trading while ignoring the real culprit. His strategy wasn't as strong as he believed. His initial few profitable months had convinced him it was a winning system. He never questioned it, never did a thorough 5-year backtest. And so when his account suffered, he blamed his psychology instead of realizing the numbers never supported his strategy. Here's the harsh reality. You can have perfect psychology on a broken strategy and still lose. You could follow all the rules, execute perfectly, and watch your account bleed. The problem might not be your mindset. It might simply be insufficient data. Ryan had done a loose backtest over 60-70 trades in a few months. It looked promising. The logic was sound. He believed in it. That belief built a wall between him and reality. He kept looking for problems in the wrong place. More journaling, more meditation, better psychology. None of it worked because he didn't actually know if his strategy was profitable. I faced the same issue. I had 6 months of data, thought my strategy was solid, and stuck with it. Things went wrong, and I searched for solutions in psychology. It wasn't until I conducted a proper 5-year backtest that I realized my strategy wasn't performing as well as I thought. Only then could I identify the real adjustments needed, improving the win rate and refining my approach. The lesson is simple but often ignored. Data first, psychology second. Whatever your trading pair or strategy, you need at least 5 years of historical data. Spending just a few weekends gathering 3 to 4 hours at a time is enough to see whether the problem lies in your strategy or in your execution. Case in point, Casey, another trader, approached her strategy differently. She ran 5 years of back-tested data across over 400 trades, covering multiple market conditions, trending markets, ranging markets, volatile periods, and calm periods. The numbers revealed a clear, repeatable edge. She knew her strategy worked, but her psychology was a challenge. She overtraded, adjusted stops emotionally, and reacted poorly to losses. The difference between Casey and Ryan wasn't discipline, it was certainty. Casey had proof that her strategy worked. When things got tough, she could go back to the data and say, "This strategy is solid. The issue is in my execution." That certainty gave her a foundation to fix her psychology systematically. Ryan, in contrast, spent 3 years fixing psychology on a shaky foundation. Casey spent 8 months doing the same, but with proof of her strategy. She knew her edge, measured her average winners versus losers, and calculated the necessary sample size to see her edge materialize. This knowledge prevented panic during losses and allowed her to navigate trading challenges with confidence. Without data, every loss feels catastrophic. With data, losses become navigation points. You know where you are, you know it's temporary, and you can continue executing. Ryan's story shows that working on psychology without a solid strategy is wasted effort. He eventually realized the problem, but only after losing significant time, capital, and emotional energy. The critical takeaway is this: proof of strategy is non-negotiable. Before dedicating years to mental training, ensure your strategy actually works. Gather enough historical data, backtest thoroughly, and validate the numbers. Only then can psychology and execution improvements be meaningful. One of the most common mistakes traders make is assuming short-term results represent reality. Testing a strategy over just a few months, taking 30 or 40 trades, and declaring it profitable is almost always misleading. 30 trades say very little. The variance in trading is massive. A bad strategy can look good in 30 trades, while a great strategy can appear terrible. To have confidence in your system, you need at least 200 trades to see something real, and ideally 500 trades or 5 years of data. The bigger your sample size, the more accurate your picture of the strategy's edge. My personal recommendation: if you trade a particular pair, backtest at least 10 years of historical data. This provides the most trustworthy insight. Only then can you confidently separate strategy flaws from execution issues or psychology. Market conditions add another layer of complexity. Markets aren't static. They trend, move sideways, become volatile or settle down. A strategy that works perfectly in a trending market may fail in a choppy environment. If you test your strategy in one specific condition and then trade in a different market, results will inevitably deviate. It's not your psychology failing, it's your sample being unrepresentative. This is why long-term testing is essential. 5 years isn't an arbitrary number. It allows you to see your strategy across multiple market cycles. Bull markets, bear markets, periods of high volatility, sideways ranges, and slow, choppy trends. If your edge holds across this variety, you have something real. If it only works in one type of market, your strategy is fragile. This is why certainty in your numbers is non-negotiable. Another challenge is interpretation bias. Humans are naturally inclined to see patterns that confirm their beliefs. For example, if you take 10 trades and win 7, you might think you have a 70% win rate. But what if those 7 wins occurred during a trending week where almost any system could succeed? Your brain celebrates the wins and ignores the context. Emotional attachment before verifying a strategy is dangerous. The more you want it to work, the more you'll see evidence that supports your desire. Even if the real numbers tell a different story. Meet Jordan. He traded the same breakout setup for 14 months. Results were inconsistent, some months profitable, others slightly negative, roughly flat overall. He assumed psychology was the problem. Entries weren't perfect, execution inconsistent. He spent 6 months working on mindset and discipline. Yet his results didn't improve. In fact, they worse, and slightly. When Jordan finally did a proper backtest, the truth emerged. His strategy had a 44% win rate, an average winner barely larger than the average loser, and a flat or slightly negative expectancy over 3 years. The market had shifted since he initially designed the setup, quietly eroding his edge. For 2 years, he had been optimizing psychology on a car with no engine, trying to accomplish the impossible. Here's the bigger lesson. Every trading book emphasizes psychology. Mindset is everything. Control your emotions, master your mind. All true, but incomplete. Many teachings assume your strategy already works. They assume the foundation exists. Ryan, for instance, skipped verifying the foundation. He built a mansion on sand. 3 years decorating rooms in a house that was sinking. He believed, assumed, and trusted. But trading doesn't reward faith. It rewards reality, and reality demands proof. Proof isn't hope, theory, or a few good months. It's verifiable, repeatable, data-backed proof. Without it, perfect discipline applied to a broken system is a massive waste. Ryan didn't have that proof. He paid with time, capital, and psychological strain. Worse, he blamed himself for failures that were never his to fix. This is the risk of skipping the hard work of backtesting and data gathering. On the opposite side, some traders use data as an excuse to avoid trading. They endlessly backtest, seeking one more year, one more market cycle, one more confirmation before committing. This is analysis paralysis, dressed in rationality. It's just as costly as trading a broken strategy. Because real proof comes not only from historical tests, but also from live trading. Backtesting shows what worked historically, but live execution shows whether you can actually implement it. The goal isn't perfection. The goal is honest assessment. The goal is honest assessment. You need enough data to confirm that your strategy has a real edge before investing years in psychology work. That means at least 500 trades or 5 years of verified data, covering multiple market conditions and honest numbers that haven't been cherry-picked. Only with this foundation does psychology work have real value. Without it, you're building in the air. Ask yourself honestly, have you proven your strategy actually works? Not just that you believe it works, not that it looks logical. Have you run it over enough trades, in enough market environments, to know your edge is real? If the answer is no, this is where you start. Not with mindset. Build your sample size. Backtest rigorously. Use at least 2 to 3 years of historical data, preferably 5. Test it in different market environments. Calculate your true win rate, your average winner to loser ratio, and your expectancy. Get the honest numbers. Once you have this, you know exactly what you're working with. You can trade with confidence, understanding that even losing periods are just variance within a proven edge. Without it, every loss feels catastrophic. With it, you navigate setbacks with clarity and discipline. This is the point where many traders fail to connect the dots. They work on mindset endlessly, ignore strategy validation, and wonder why results are inconsistent. The reality is simple. Psychology is important, but only second to verified strategy. You cannot fix yourself abstractly. You must close the gap between what your strategy can produce and what your execution currently delivers. In short, data isn't just proof, it's a map. It tells you where normal losses lie, how long losing streaks can last, and when variance is expected. Without it, traders misinterpret natural fluctuations as failure, losing confidence, and misallocating their effort. With it, they navigate markets systematically, adjusting execution where necessary, but trusting the underlying edge. Once you've verified your strategy with solid data, the next step is execution. This is where psychology truly matters, but only when your foundation is real. Traders like Casey succeeded because she combined a proven edge with focused execution. She knew her strategy worked, had tested it across hundreds of trades over multiple market conditions, and could rely on the numbers during tough weeks. When losses happened, she didn't panic. She checked the data, confirmed she was following her rules, and understood that variance was natural. When 3 losing weeks occurred in a row, she looked at the historical longest losing streak, 4 weeks, and recognized she was still within the expected range. Data gave her a map of normal. Without that map, losses would feel catastrophic. With it, they became navigational points, guiding her decisions instead of dictating her emotions. Contrast that with Ryan. He spent years fixing psychology on top of nothing. He didn't have proof of his strategy's edge. Every loss felt like a personal failure. Every drawdown triggered doubt and overcorrection. Even after 3 years of disciplined mental training, he still lacked the clarity and confidence that comes from verified numbers. The difference wasn't discipline nor talent. It was sequence. Data first, psychology second. This is the critical takeaway for traders. Mindset alone cannot compensate for a flawed strategy. You can meditate, journal, visualize, and practice every psychological technique available. But if the system you're trading doesn't have an edge, your efforts are wasted. Perfect execution on a losing strategy still produces losses. Backtesting and live testing provide the proof you need. But you must also avoid analysis paralysis. Endless backtesting can become a crutch, a way to avoid facing real market conditions. Historical data is only valuable if you eventually apply it in real trades. Live execution shows whether you can actually follow your rules under pressure. You need both solid historical validation and real-world application. Once you have both, psychology work becomes precise and actionable. It's no longer abstract self-improvement. It's targeted adjustment. You fix the aspects of your trading that truly matter. Overtrading, emotional stops, hesitation, or impulsive entries. Every improvement directly impacts performance because it operates on a foundation that already works. The key metrics you need to track are win rate, the percentage of trades that succeed over a large sample size, average winner versus average loser, the ratio of gains to losses, expectancy, the expected profit per trade over time, sample size, and variance, enough trades to identify trends and avoid misleading results. Without tracking these, you are guessing. With them, you gain certainty. For example, if your strategy has a 45-50% win rate, but your recent trades show 35-40%, it's not necessarily a failing system. It could be variance. Data lets you know exactly where your strategy stands. This clarity allows you to focus mental effort on execution rather than questioning the system itself. Another important aspect is understanding market conditions. Markets change. A strategy edge in trending conditions might fail in sideways or choppy environments. 5 or 10 years of data will expose how your system performs across cycles, helping you adjust position sizes, risk, and timing to match conditions without second-guessing every trade. Remember, your edge doesn't have to be perfect. Casey's strategy wasn't a holy grail, but it had a repeatable advantage. That advantage, combined with disciplined execution and clear psychology, allowed her to reach her profit goals. Ryan's mistake was building psychology on a shaky foundation. He tried to perfect the wrong part of the system. Here's the ultimate framework. Data first, verify your strategy with at least 500 trades, or 5 years of historical data. Know your real win rate, average winner-loser ratio, and expectancy. Execution second. Apply your proven strategy consistently in live markets. Follow rules, manage risk, and execute with discipline. Psychology last, focus on behavioral adjustments that directly impact execution. Controlling impulses, managing overtrading, and maintaining emotional balance. Following this sequence is crucial. Psychology is powerful, but only when it operates on a system that works. Trying to fix yourself without a verified edge is like polishing the dashboard on a car without an engine. You may look disciplined, but you won't get anywhere. Finally, consider this. The traders who achieve consistent success aren't necessarily the most emotionally controlled or naturally talented. They are the ones who stopped guessing and started knowing. They invested in verifying their edge, tracked their metrics meticulously, and adjusted execution intelligently. Then, and only then, did psychology become the tool to bridge the gap between what the strategy could produce and what they were actually doing in the market. In conclusion, extract your strategy's data, backtest thoroughly, know your numbers. Trade based on verified edge, not hope or short-term results. Use psychology to optimize execution, not to compensate for a broken strategy. Trust your data. Let variance and market cycles inform, not intimidate. When you do this, you're no longer guessing. Every decision is informed, every loss is contextualized. You can act with confidence and clarity, knowing your system has an edge and your execution is improving. This is the difference between trading in circles and trading for consistent profitability. Remember, nothing is more expensive than perfect discipline applied to the wrong strategy. The first step is always proof. Only after that can you build psychology, execution, and long-term success. Now that you've verified your strategy, applied it in live conditions, and optimized your execution, the final layer is mastery, maintaining consistency over the long term while continuously learning and adapting. This is where top traders separate themselves from the rest. It's not about short-term wins or quick fixes. It's about sustainable performance built on evidence, discipline, and adaptation. Mastery begins with trust in your process. Traders like Casey had this trust because every step was backed by data. She knew the historical performance of her strategy, understood her edge, and had systems in place to handle losses without panic. Each losing week became a checkpoint rather than a crisis. Knowing your edge allows you to make rational decisions, even when the market challenges your patience or confidence. Consistency comes next. Many traders fall into the trap of chasing perfection. They think that every trade must be flawless or that every psychological adjustment will instantly fix results. The truth is, trading is about process over perfection. Consistency isn't about never losing. It's about repeatedly executing a proven edge correctly. A trader with a solid strategy who occasionally loses still outperforms someone who wins sporadically but breaks their rules. Ryan's story illustrates this perfectly. His failures weren't due to a lack of effort or dedication. They were due to misaligned priorities. He worked tirelessly on mindset, emotional control, and journaling, but all that effort was layered on a weak strategy. The foundation wasn't there, Even perfect execution couldn't compensate for a strategy without a verified edge. Ryan's experience highlights a crucial lesson. Without data, psychology alone cannot create consistent profits. This leads to another critical principle: continuous monitoring and adaptation. Markets evolve. Volatility, liquidity, trends, and correlations change over time. A strategy that performed flawlessly 5 years ago may lose edge if conditions shift. Top traders continuously monitor performance, reevaluate assumptions, and adjust as necessary. This doesn't mean abandoning your system at every setback. It means maintaining awareness, tracking metrics, and making informed adjustments. Sample size and VAR remain your most powerful tools here. Even with a proven strategy, losing streaks occur. Without sufficient historical data, these losses feel catastrophic. With data, you recognize them as part of normal variance. For example, Casey understood her system's longest losing streak, how much risk was reasonable, and what outcomes to expect over multiple market cycles. She didn't react emotionally. She executed. Psychology now plays its true role. It bridges the gap between knowing and doing. Once you trust your edge, your mental discipline ensures you execute consistently under stress. Impulsive entries, overtrading, or emotional stops are minimized because you know what the system can realistically deliver. Psychology becomes the tool for consistency rather than a crutch for uncertainty. The synergy of data, execution, and psychology produces predictable results over time. This is not luck. It is statistical certainty. Traders who reach mastery stop guessing. They do what the numbers tell them, trust the process, and adjust only when informed by evidence. They understand that every edge has limits, every system has variance, and every market requires respect and observation. Another key component of mastery is documentation. Maintaining detailed records of trades, outcomes, and decisions is essential. This practice allows you to detect subtle changes in your strategy's performance, identify behavioral patterns in execution, and ensure that your edge is preserved. Documentation transforms experience into actionable insight. It converts months and years of trading into data you can learn from rather than random anecdotes you rely on instinctually. Long-term success also demands risk management. Even a proven strategy can fail without proper capital allocation, stop-loss discipline, and position sizing. Data informs risk decisions. Knowing the statistical expectancy and on-the variance of your strategy allows you to size positions intelligently and withstand inevitable drawdowns. Traders who ignore this step are gambling, not trading. Finally, mastery requires humility and patience. Markets are complex and unpredictable. No strategy is perfect, no execution is flawless, and losses will always occur. But by following a structured approach, data validation, consistent execution, disciplined psychology, ongoing monitoring, and risk management, traders can achieve results that are not only profitable but sustainable. Here's a concise blueprint for long-term trading mastery. Data first. Validate your strategy with large sample sizes and multiple market conditions. Know your win rate, expectancy, and average winners versus said versus losers. Execution second. Apply your strategy consistently. Follow rules, manage risk, and resist emotional decisions. Psychology third. Optimize mindset and behavior for execution. Focus on impulse control, overtrading, and emotional management. Monitor and adapt. Track performance continuously. Adjust only based on verified metrics, not emotions. Document everything. Record trades, outcomes, and observations. Use this as a feedback loop to refine strategy and execution. Manage risk. Apply statistical understanding to position sizing and drawdown control. Protect capital and sustain longevity. Trust the process. Accept variance. Respect cycles. And maintain patience. Success is built on evidence-based execution over time.